Welcome back to Visions and Voices, the podcast where we explore these ideas, strategies, and innovations shaping the world of family offices, wealth management, and ultra high net worth families. I'm your host, Chris Mays, partner at Armanino and leader of our family office practice. A few weeks ago, I sat down with Christopher Karachale, partner at Hanson Bridget and one of the nation's leading authorities on qualified small business stock, to talk through the fundamentals of QSBS and the mechanics of stacking, multiplying the exclusion across multiple taxpayers and trusts. That conversation generated more questions than we had time to answer, so I'm glad to have Christopher back today to go deeper on the other half of the playbook, QSBS hacking. If stacking is about multiplying the number of taxpayers who each get an exclusion, hacking is about making each individual exclusion bigger. The Section 1202 exclusion is the greater of a fixed dollar cap or 10 times your basis in the stock. For most founders, the dollar cap is the binding number. But with deliberate planning years in advance, the 10 times basis path can unlock exclusions that run well into the tens of millions and in some cases far beyond. The catch is that packing depends on decisions made early, often at formation or at conversion, and the techniques carry real traps around holding periods, the gross asset ceiling, and economic substance. The timing could not be more relevant. The One Big Beautiful Bill Act reshaped the QSBS landscape in 2025, raising the dollar cap, lifting the gross asset threshold, and introducing tiered holding periods for newly issued stock. Those changes alter the math on packing in ways that every founder and family office should understand before a liquidity event is anywhere on the horizon. In our conversation today, we'll cover what packing actually is, how it differs from stacking, the principal techniques for loading basis into QSBS eligible shares, and how OBBBA changes the calculus, the mistakes advisors make most often, and what families holding concentrated private positions should be doing now. Christopher, welcome back to Visions and Voices.
Thanks, Chris. It's always a pleasure to talk with you. And we have fun, right? We just tell jokes.
We get to nerd out on this stuff, but for a small segment of the population, hopefully this information is very helpful. Look, last time we were focused on stacking. And for listeners who are new to this distinction, how would you describe the difference between packing and stacking? And when does each one actually matter?
Yeah, well, you did it at the beginning, right? I mean, stacking it. So the now post OBBA, the rule says each taxpayer can exclude the greater of 15 million or 10 times your basis.
Yeah.
Okay. And so stacking is about how do you multiply that $15 million exclusion, right? If you gift shares at QSBS, you can multiply that.
Yeah.
Packing is trying to use that basis to multiply QSBS for the individual shareholder, right? Because, like the sort of most basic example is, let's say I'm an angel investor, okay? And I invest $8 million in a startup. They're friends and family or their seed round. I cover their whole seed round, right? So I invest $8 million and get my preferred shares or whatever it is, and I take them back. Then 5 years later, I sell all of my holdings for $80 million. Okay. At that time, we test. Does Christopher get the greater? We say for each taxpayer, you include the greater of 15 million or 10 times your basis, right? So at 15, I only exclude 15. But if I invested $8 million, that's my basis. I get 10 times that. I get $80 million of exclusion, right? So in that hypothetical, we're selling for 80, I can get the greater of 15 or 10 times 8, I can wash out all my QSBS exclusion without any stacking. I don't have to give anything away.
Right. Yeah. So most people have never focused on the 10 times your basis. I think 90+ 90+%, if not 95+% of the QSBS transactions that I've done or we've done historically, Armanino, it's been the $10 million or now the $15 million
And
fixed.
that's what normally, because 90% of the time you're dealing with QSBS, it's founders, right, who start their tech company or whatever it is, and they pay $200 for their shares, right, and they take back 1 million founder shares in exchange for 200, $500. They're never going to be in the packing or the 10x world. Now we can talk about some little exceptions, right, as we get into this, but in general, it's for most founders or even early employees who early exercise their ISOs, they're in the stacking world, right? They're going to sell 10 million or 15 million or whatever it is, and they've got to give to their kids and do the non-grantor trust and everything else. Now, there is concern, right? I know that the Treasury Department is working on regulations about how, are people being too aggressive about the stacking, that are they setting up too many trusts, that sort of stuff. So I do think that there's some concern about are people being too aggressive about stacking. But at least with packing, say, I invest $8 million, I can exclude $80 million. It's easy, right? We'll talk about LLC-to-C-corp conversions. There's also situations where, like, if I have a bunch of options, right, and the company's still under 50 million or now under 75, I can exercise those options going into the transaction, create basis, right? I have to pay short-term capital gain, but if I create basis there, I can actually multiply. So, there's lots of packing, like stacking, has lots of different iterations, right?
Yeah. Well, where the 10 times your basis regimes come in, it's typically like a family office invests, $2 million into a company, and or in one case we had $5 million, right? But look, these companies all have a value sub, at least pre OBBBA, they had they had an accounting value of less than $50 million, and it's hard to write a check of size into those organizations, right? They're nascent organizations, and nobody knows whether they're going to be successful. So it was odd to get a check, larger than $1 million into one of those. So
it almost never happens that you have.
It almost never happens. I only saw it maybe probably less than a dozen times did I see it actually. I had some family offices they wrote some fairly significant checks, and those investments worked out. But I never saw a founder get it. So or an employee, an early employee. So let's talk about those two scenarios, because you brought up two that I'm aware of. Maybe there's others, but yeah, the option exercise prior to exceeding the gross asset test, or the LLC to C-corp conversion, because that's one here that more recently we've call it inside the last 24 months or so, we've seen a lot more of those transactions.
Yeah. Well, let's start with the LLC to C-corp conversion, because that's, I think, become increasing. In fact, now we're regularly working with founders in Silicon Valley who are expressly trying to do this packing through the LLC to C-corp conversion. Right?
Yeah. Well, it's because I've had a couple of VCs reach out on this, because the VC tooling doesn't have the LLC playbook, and it kind of reminds.
They don't want to invest. They won't invest in LLCs generally. Yeah.
Right. Well, largely because they want the QSBS, but it's reminiscent of what we talked about last time, where QSBS didn't really get any kind of traction until the VC community they embraced it. They finally got it, and then it was like within 30 months, every single venture-backed company inside of Silicon Valley and probably globally, now had all of their SAFE agreements, had the QSBS language, all of their corporate resolutions, they would all issue memos to their shareholders about QSBS, and then a lot of the venture funds were taking carry on their or QSBS treatment on their carry. So let's talk about this LLC conversion, because I want to break it down. I want to kind of think through each piece of it. So, but to start, tell me in a nutshell how it works.
Okay, so this goes back to sort of just basic principles. Remember, the rule says in order to get QSBS, you have to get the shares at original issuance. Okay, which means I have to get the shares in exchange for cash, property, or sweat equity.
Right.
This LLC-to-C-corp conversion is all about property. Okay. So the rule says if you contribute property, you get shares of QSBS. And what 1202I says is that if you contribute property in exchange for your shares, your basis is set at the fair market value of the property contributed, right? Which is crazy, because you always get like with LLC-to-C-corp, like LLC contributions, right? 721 says you contribute property, it's a carryover basis. 1202I is this, apart from death, you never get a step up in basis, right?
Yeah.
But 1202I creates this step up in basis. So if, for example, I have IP worth $6 million, and I know I can quantify the value of my IP is worth, computer code, whatever it is worth $6 million. If I contribute that IP into the C Corp and take back shares in exchange for that IP worth $6 million, I've satisfied my original issuance requirement, and 1202I says it sets my basis at the fair market value at $6 million, right? In other words, it's just as good, at least for the 10X, as contributing cash.
Right.
So I contribute that IP worth $6 million. That means in 5 years when I sell, I can exclude the greater of 15 million, or 10 times 6 million, 60 million. Right? Now, there are some special
Now,
rules.
hold on. So we glossed over this a little bit, but actually you were calling out. So you're right. That is the only other place.
Yeah, it's crazy. It's
crazy, right? Because you're effectively avoiding income tax on.
Well, that's on the contribution, but what's important?
Yes.
On the back end, you got to pick it up.
That's right.
So and so the legislative history to 1202 speaks to this. And so it basically says, like, in my hypothetical, I contribute IP worth $6 million, and then when I sell for 60 million, I can exclude 10 times that. 10 times 6 is 60 million. However, at that time, I have to pick up the unrealized gain that existed, right? That first 6 million. So I got to pay tax on the 6 million at long-term capital gains.
Yeah.
But I can avoid tax on 54 million, right? Given that 10X. So it's huge. And now most people just don't have 6 million of IP sitting around. That's why we see the LLC, because most of the time what happens is Chris Mays and Christopher Karachale are founders, and we're second time or third time founders. And now we're like, hey, let's get together and iterate on some ideas in that LLC for the next 6 months. So we start to develop IP in the LLC, right? Then when that LLC is worth $40 million, right? So the VCs come along and say, hey, Chris, if you guys convert, we'll invest 10 million on a $40 million pre-money value, right, in your LLC. But you got to convert that LLC. So we convert the LLC at a fair market value of, let's say it's about 40 million, right? But let's just assume 40 million. We convert, right? Then you and I are 50-50. That means we each have 20 million of basis. Someday we can exclude 200 million each. Again, with the basis pickup, at that time we'd have to pay tax on the first 20, so it's really 180. But that's increasingly a favored technique of second or third time founders to try and max out that basis. And of course, all the founders in Silicon Valley are insane, right? And they're all like, we're going to go out to 74.99999 million and convert. And so we're going to get $749 million of.
Well, but I mean, I don't want to argue that one in front of the IRS, right? The value.
No.
You can't get too close to the threshold on that, because I'd hate to get it kicked out because
Yes.
So
that's right, because those are some of the limitations. So for example, if you go over 75 or before OBBA, if you went over 50, you blow QSBS.
it evaporates 100%.
Everything's gone. You don't get it, right? Because 1202D says that your basis is the fair market value is no less than the basis, right? For purposes of the 50 or the $75 million test. And so you have to be careful if people are going to, and we see this with people in Silicon Valley in the AI space. These guys just get together and have a great idea. They can get pre-moneyed at $80 million. They'll blow QSBS just by sitting down together and thinking about some cool agent they're going to build.
Right. So, okay, but when you say second, third time founders, why doesn't it work for first time founders?
Because I think most first time founders are not aware of it. Don't think through this. In other words, the typical paradigm for startup guys in Silicon Valley is start a Delaware C Corp and try and raise money as soon as you can from venture capitalists.
But that's largely because of the venture capitalist advice. Like, if you look at all of these programs, like Y Combinator or like any of them, you got kind of on Hacker News, they've got a kind of a standard playbook.
That's right.
About how they walk through this, and yet they're missing this opportunity.
For sure. But again, there's lots of like this is an awesome way to maximize QSBS, but there's drawbacks, right? So for example, let's say Mays and Christopher Karachale form an LLC, and it takes us 18 months to get to 16 million, right? Then we've deferred. Remember, I got to hold QSBS for 5 years, C Corporation shares for 5 years. So now we've deferred, we've eaten in, like we haven't even started our QSBS holding period, right? Now we basically have to run for 6.5 years to get to the exclusion. So there are like the LLC is not some panacea for everything, right? Like there's and like in Silicon Valley, nobody understands LLCs, right? Like let's say you and I have to run for 18 months and we want to hire engineers, and they're like, hey, give us options. You can't give them options. What are we getting, like a profits interest in the LLC? So
very practical limitations. Yeah.
Right.
Yeah.
So it's not the perfect fix.
But have there been any venture capitalists that have embraced this mechanism yet?
So we spent a lot of time talking with the folks on Sand Hill Road, and they're very apprehensive about any investment because they have foreign investors, they have tax exempt investors who don't want some active trade. Like if you invest in an LLC,
right,
you're going to trigger all sorts of potential risk.
DI and all of the other
TI, right? UBTI. So there's lots of potential problems, but I think given this sort of increase in popularity of this technique and the way it can multiply exclusion, maybe the VCs will change them. Or they can set up a blocker if necessary. They can set up a blocker and do so. There's
right. There are paths around some of those problems, but but the incentive comp for bringing on additional founders or additional employees, like it's a real issue, like because you can't really issue options. There's some other vehicles you could ostensibly put in place, right?
Right. But you could, like, if it works and if you have sophisticated early employees, they can become profits. Like, let's say you and I are the founders and we start the LLC, and then Megan comes along and we want to add her as an employee, right? We could give her a profits interest, and that profit, we'd set the benchmark. And then when we convert, Megan potentially gets part of the QSBS benefit too, right? She could see the upside as well. So there are, if you're dealing with a sophisticated enough cohort of founders and early employees, it can be a benefit for everybody.
Yeah. It's interesting. Most of the use cases we've had for this, and I know we've worked on a couple. The founders weren't taking traditional VC routes, right?
Yep.
So I had one founder that the business was good day one for cash flow. It wasn't one of these types of business where they were building for 2 years and then testing product market fit, and it wouldn't be profitable for maybe 8-10 years. It was profitable day one, and so they wanted the pass through because it was tax beneficial for income tax purposes day one. And So they formed as an LLC. Now they did the conversion eventually because the you know
They wanted VC investment or whatever. They had to just do it. Yeah.
they had to do it. Yeah.
Yep.
So
No,
it forced
that's
the
one of
issue at
my.
that point in time. But then it was kind of
It
accidental,
was
right?
accidental.
They were like, wait
Exactly.
a second, you mean we're so in the instance I'm talking about right now, it's like $35 million was where the
Yep.
valuation came at. So they have $350 million worth of
It is
exclusion.
my favorite phone call because this happens all the time, right? Where people say, "Hey, we're going to have this exit. We want you to write an opinion letter, map out all the QSBS stuff." So we're like, "Fine, send us all your documents, original formation documents, everything else, right?" And they're thinking we're going to get 10 million or 20 million,
Yeah, right.
with the stacking and whatever. And then we go through it, and I'm like, "Wait a second, what?" In
Yeah, no,
they were an LLC. They converted in 2018, as you say, at 30 million. And one of my favorite phone calls is to call up the founder and be like, "Hey, look, do you realize you
yeah,
were 50%, like you can exclude $150 million?"
you
Those guys are like,
tripped
"You were my
and
favorite friend.
fell.
I'm the best friend of all those founders forever."
You tripped and fell into a couple
Right,
$100 million
right,
worth
right.
of
And
tax. And the
this is,
worst case is I will promise you that there are folks that had this situation and their advisors just weren't
yep,
that
they
because
missed it.
by the way, this is super niche stuff. So I'm not trying to blame advisors, but if they don't deal in this stuff on a day in and day out basis, like
Yep,
your average CPA maybe sees this two or three times in their entire career, okay?
yep,
And or maybe never,
yep.
I probably the vast majority never see it. And so, dealing with the folks that are kind of regularly seeing this, dealing with it on a day in and day out basis are just, it's worth its weight in gold.
No, it's amazing, right? And that's right. And that's the key, right? That's why ultimately it's worthwhile to hire a good advisor, or at least people who know about this stuff, right? And
Yeah.
can
Who
spot
are,
these things.
who are trafficking in this subsection of the world.
Yep.
But what about economic substance? Like, there start a little bit with some of the limitations inside of 1202, the types of businesses, and then let's talk a little bit about economic substance and maybe the first one,
Yeah.
a little bit of a refresher, but
Okay, right. So, I mean, we're talking about this very narrow little element of QSBS. It says each taxpayer can exclude the greater of 10 million or 10 times his basis, right? To avoid 23.8% feds or in conforming states, the local and state tax as well, right? But there's lots of other requirements, right? That you get your shares under 50 or 75, that it's a domestic C corporation. The LLC, once it converts, satisfies that. And we didn't spend very much time during our last call about 1202E3, right? About what is a good qualified traded business, right? And
that's right.
so I spend most of it, I think you and I and most of our calls are thinking a lot about what is a good qualified traded business, 1202E3, right? And 1202E3 says a qualified trader business is any business other than a business in 20 listed fields: health,
Yeah,
legal, accounting, financial services, banking, brokerage services. Basically, every single fintech that was ever created in Silicon Valley is on that list.
yeah,
If you read it just on its face.
that's right.
Okay. Now, the IRS has put this very issue on the no letter. They'll no longer issue guidance about this because the IRS is producing regs, maybe dealing with stacking, as well as this question where I think they'll try and elucidate what these rules mean. But the IRS has already published 11 pieces of administrative guidance. Okay. There's also a case Owen, which is not very well decided.
Yeah,
But the 11 pieces of guidance do kind of tell a story that makes sense, right? And so in those 11 pieces of guidance, they say, look, what we're really trying to do, most of them involve health companies in the health space, right? So there's like a genetic testing company, 23andMe, or a pharmaceutical company, or there's actually a med tech company that was developing software. And when you read those letters together, what they're really trying to say is we don't want companies that are just service providers to get QSBS.
Yeah.
Right? Like Chris Mays doesn't get QSBS because all
right.
you do is provide advice based on your skill and reputation. Right?
That's right.
You're not building anything. Or for example, Hanson Bridget, like my law firm, there's 200 lawyers here. Okay. Most of them don't show up, but there are 200 lawyers. Okay. And if let's say all the lawyers at Hanson Bridget quit tomorrow, there'd be no value
Right.
in Hanson Bridget.
Yeah.
But look at SoFi or Chime or Robinhood or Coinbase or all these very big companies now that are arguably banks or brokerage services or all this stuff. Those guys, the founding team of those companies could all quit, and there's still inherent value in those companies, right? In other words, they built a better mousetrap. This is when I'm talking with founders in the insurtech space or the medtech space. So what I'm saying, like, tell me about what you guys built, right? And that's consistent that there's one of these letter rulings that we were talking about, right? These 11 different letter rulings involving a pharmaceutical company. It says this pharmaceutical company was in the health space. Health is the first category on the list. It said, but it's still a good qualified trader business because it was using its manufactured assets and IP to add value to its customers' lives. It was the analog of a parts manufacturer in the automobile industry, right? Because it made something, right? And it used its IP to make that, right? So what 1202 is all about is like, are you going to make something cool that makes the world better?
Yeah.
Right? If that's what you're doing, that's what startups do, right? And
but help me parse this a little bit, because there, yes, there's an exclusion on services only. But if you have IP and you're making something and you have services,
that's right.
That's okay.
Yeah, and where do you draw that line? There's from 2022 and 23, there's two letter rulings. One involves a SaaS company and another involves like a data migration company. And in the data migration letter, they say companies that do data migration for you, they come into your office, they move all there is a consulting, right? A service component to that.
Right.
But the point of the letter is to say, yeah, but that consulting element, that service element is ancillary to the underlying proprietary way that these guys know how to migrate data. That's what makes it QSBS, right? Is that you've come up with a better way to do this, that IP, right? Whatever it is.
Right. Yeah. Okay. So you have to take a proactive look at the business and understand even so just because it has some set of services, it's not a knockout.
Right. Yeah, and what a lot of people
services only, okay.
That's right.
Or if it's in one of the prohibited, but even if it's one of the prohibited, specifically listed industries, still may qualify.
It still might qualify because that's not because it's what it's really doing is build it. Like, let's say I develop some cool accounting technology, right?
Yeah.
That is able to read tax returns or read data and punch out a bunch of stuff and populate the 1040 or the 1120 for Armanino. That's technology, right?
There's
that's
a couple hundred of them. They're all QSBS eligible.
Yeah, they're all QSBS. And here's one other thing. Everybody always talks about 1202E3 in isolation, this list of 20 categories. But what you got to do, there's also the 80% test, right? So that's 1202E6. 1202E6 says that for the first two, this is when people talk about the 80% test, they're really talking about 1202E6. That says for the first 2 years of companies in business, all of the working capital, the cash you have in the company, is treated as used in good qualified trader business. But after 2 years, no more than 50% of the value of the company can be cash.
Right.
In other words, you got to have a 409A or a pre-money value or something else to show that if you guys have $4 million in the bank, your enterprise value is $8 million. That $4 million delta above the $4 million of cash is the IP, what you build, right? Your technology.
Yep.
And so when you read E3 and E6 together, you're like, oh, I see, right? Like, again, law firms, they have cash and they have people working for them, but they don't have inherent value. The same is true for accounting firms or doctor's offices. You haven't built inherent value inside of the company, right? And so when you read those two provisions together, I think you can sort of step back and see like, oh, I see that what Congress wanted with the qualified trader business question was for companies that could be in those listed categories, but aren't simply like cash flow vehicles.
Yeah. Right? Yeah. Okay. So thank you for re-clarifying that. Let's move back into the packing transaction though.
Yeah.
Because okay. So we have the economic substance. Can we move into that as a potential knockout for the packing transaction and what you have to be careful of?
Yeah, well, I mean, like economic substance is a very squishy, like what does that even mean, right? That, is there for me to transfer shares to my kids, is there economic substance for stacking, right? Or doing the 10x or, choosing to merge from we're going to do our transaction, right? So 1202H4 says that let's say I'm going to sell my company, right? I can do one or two things. I get cash for my shares, or we merge into Microsoft, right?
Right.
1202H4 says if we merge our startup, I exchange my startup shares for Microsoft shares, then the Microsoft shares I get are QSBS, right? At least up to the value at the
Yeah.
time of the merger.
Yeah. Yeah. Yeah.
And I think all of those transactions have economic substance, right? In other words, I'm making these decisions not based purely on tax, right?
Right. 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 Right.
Um, so at least there are other
In
transactions.
terms of the conversion though from an LLC to a C corp,
Yep.
are there knockouts? Like if you're like, is there anything on the economic substance argument that would disqualify an LLC from converting from an LLC to a C corp?
I don't think so. Not in terms of economic substance. I mean, you can violate, like you can buy, if you converted over 75 million of fair
Yeah.
market value, then
Right.
you're definitely boxed out. But that's just a statutory requirement. I don't think that's economic substance. There are other things like holding period. Could you make the argument that the LLC, there is guidance, there's a revenue ruling 84-111 that says you can count LLC holding period for a C corporation? That for economic substance makes me anxious, right?
Yeah. 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 Yeah.
Um, but I think that as long as you're being thoughtful, for founders who want to proceed down this way and do the 10x and use an LLC, as long as you're thoughtful about it and you get a good valuation at the time of conversion and you lock
Well,
down.
let's talk a little bit about that. A good
Yeah,
valuation, because I mean, valuations and they're some people feel like they're a little bit squishy. And
yeah, they're 100%. In fact, like, but we won't opine. We write lots of opinion letters about lots of different QSBS issues. We will not opine on value. In
yeah,
other words, I don't know what your LLC is worth when it converts. Nobody knows. Now, maybe the VCs are investing at some pre-money that's close to the value, but even that may be wrong. You may have hoodwinked the venture capitalists into thinking they're shares. So but there's lots of very good. I mean, Armanino, there's lots of good
we
valuation
do
folks
that.
around.
We do those valuations, but I like, if this is what you're planning to do, then you need to start talking to a valuations team early because
Yep.
yeah, you don't want to accidentally trigger something that makes it impossible to
Right.
go back, to once you've reached that $75 million threshold, there is no going back, right? That is a one-way door.
Yep. Yep.
And
Yep. Or let's say you convert, like here's the worst case scenario, I think, right? Let's say you convert and you don't get, there's no funding round and you don't have a contemporaneous valuation. So you don't have no outside, right? But you do it because
validation
you
of
say
the
you want to
value.
go.
Yeah.
Then 5 years later, you sell for 800 million and you say, well, we're going to go back now and get somebody to value the company 5 years ago when we did that. That, if the IRS looks at this, is going to say it's an entirely self-serving valuation to do that historical valuation. Now, maybe it's right. Maybe you'll end up fighting with the IRS about what that number is. But I do think if people are going to do this, they should spend the money and the time to lock down that value.
Value contemporaneously. Yeah, no, I 100% agree. Now, we've done that a few times where we've gone back, we've been successful there, but yeah, I hate to rely on that because
Yeah.
well, first of all, the valuations team is looking at that future value too, and they've got to come up with really good arguments why it wasn't worth that at the time, knowing what the outcome is. And
Exactly.
it's a lot easier to do that when it's contemporaneous and you're doing it blind. You have no vision of the future. So yeah. So okay. So what else do like for founders that are, oh, well, let's close this out and then let's go into the option exercise. Is
Yeah.
there anything else that founders, if like let's say, that they're starting a new company, like are there any other considerations when we've talked a little bit about the employee incentives, right? No direct replacement for options, but for the profits interest, but you'd have to be fairly sophisticated in terms of walking through all those things, and you're founding a company, so it's taking your focus off all of the other things necessary to make a successful business. But is there anything else in the LLC transaction that folks should be thinking about? I mean, we got valuation, we got if you're gonna go 3 to 4 years without getting to a conversion point, that maybe doesn't make sense. Of course, if you're gonna be in a conversion in a couple of months, like a lot of AI companies.
Yeah, and that's what we're seeing, guys. Within a few months, it goes up to $40 million. It's remarkable now.
Yeah.
No, but that's it. I think as long as you're prepared to defer your holding period for a little while, right? As long as you're prepared to deal with the fact that if you can't get employees, and that you should probably budget for more costs to make sure you lock down valuation at the time of conversion.
Well, it isn't that you can't get employees. It's just the employees that you're trying to attract and retain, they're being thrown option numbers, right. And you're going to have to say, well, you're getting this new thing.
You get a K1, right? You're going to get a K1 next year, right?
By the way, we're going to make it a lot harder for you to file your tax returns. You're getting this thing. It's called a profits interest. Nobody on the planet's heard about it. You can't go look it up inside of Substack or Hacker News or any one of the sources that people are checking their offers against. And so you put yourself in a little bit of a less competitive position ostensibly, although you could make the argument, well, look, if this is successful, you get all this money, and you're not going to owe any tax on it. So, so there's two ways to skin that cat. But okay, let's put a pin in that one, and let's move over to the options exercise, and talk a little bit about how the stacking transaction works with that.
Yeah, and so this is, for a long time, when people were talking about packing, this is what they were talking about, right?
Packing, yeah.
Right, is multiplying this. And I have to say, this doesn't happen very often, right? The LLC-to-C-corp conversion is now very popular. But what the packing idea is the following, right? That let's say I'm a founder and I am going to sell for $80 million.
Right.
Right. So, $80 million. Okay, this is my hypothetical, $80 million. My company is still under 50 million or under 75, so it's still good QSBS, right? We haven't gone over the level, right? And I got my original founder shares, and I have a bunch of options that I haven't yet exercised. Okay, and we're at year 4.5 in my holding period, so I'm almost there at the end, right? And I'm going to sell. So I have, I have no basis. I have my founder shares that I paid $500 for, so there's no 10x there. But I've been granted options worth now $4 million. Okay, so to exercise those options, I'd have to come up with $4 million. But let's say I can borrow that from somebody, so I do exercise those options, right? And I buy the shares for $4 million. Then I just hold those shares for a year or whatever, 6 months, a year. Let's say it's for a year, right? They're not QSBS yet because I haven't hit 5 years. But the 10 times basis says, as long as you have basis in any shares that are QSBS eligible, you can get the 10 times basis, right? So here, I knew in this transaction that I needed to create more basis, and I had these options that I could exercise and buy for $4 million. Now, I only held that tranche of QSBS for a year before the deal closed, but that created basis of 4 million. Now I'm at 40 million because I can use those options to offset the 40 million I need to wash out from my original founder shares.
Right. So it's any basis.
Yes, that's the key with that stacking with options. You say, as long as you have shares at QSBS, even if those don't hit the 5 years, you can use those to create basis. This packing scenario with the options is pretty unusual, but we see it happen, every once in a while.
Well, why do you say it's unusual? I mean, yes, I haven't seen a ton of cases of it, but Well, okay. I know one of the largest reasons is people often don't have the
Yeah,
exercise.
you don't have $4 million sitting around,
Yeah.
or by the time you get to a point where you're at the exit, you're over the 50 million or the 75 million. Remember, at the time you exercise the options, you still have to be under the limits because you need to get more
Right. Right.
QSBS. So it's kind of this narrow subset, but again, it's okay. It's just founders in particular should be aware of this, and
Yeah.
if it can work, you can shoehorn your way into more basis.
Right. 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 Well, okay, but let's take a scenario that's like more likely given valuations right now. I mean,
Yep.
$80 million. You're going to sell for $80 million in 5 years. I don't. Most people are getting into the game are looking at a number that is
A
probably
lot.
larger than that, and they have to actually go 10 years in order to do it. But the number could be 10x or more than that. Um, so. And you would have gotten tranches of options. Like let's say you got founder shares up front, but then you
Yep.
would have gotten subsequent tranches of options, maybe on an annual basis for a certain set of vesting. And um, so you get to the 5 year mark. Okay, your founder shares are QSBS eligible.
Yep.
Um, but actually you wanted to exercise prior to that 5 year mark, right? You would have needed to do that before the QSBS because you have to establish basis before the end of that
Right.
five.
But it's okay. I could exercise at year 6, right? I'm at year 6 and we're going to sell, and I still have these options. As long as we're under 50 million or 75 million, I exercise those options. I can
Yeah.
even take
Okay.
short-term capital gain for those options for 4 million bucks. It's like a huge hit, right? For those options.
Oh, right. Because you still have the income tax
Yes,
issue. Yeah.
that's
Okay. So
right.
you have the strike price plus the income tax issue,
Yep.
and no, that okay. So it is. Yeah, it's good, but it requires you to have enough access to enough liquidity to well, because the other thing is like if you exercise the options early, you don't necessarily create the basis.
That's right.
Need
Then you don't create,
Yeah,
that's it.
yeah. So
That's why this is sort of a real
it's
narrow circumstance.
niche, yeah.
Yeah,
The 50-75 million dollar test becomes a really difficult.
right. Because
You got to. It's got to be in that kind of 3 to 5 year window that you're kind of coming up against the $50 million test in
you
order to
got
make it make sense. You have to have just enough appreciation that your options will create basis upon conversion,
right.
upon exercise, and you haven't breached the $50 to $75 million test. Okay, so pretty nichey. Yeah, it makes me kind of want to go look out through all of the universe of venture companies and
Yep.
see if I can't narrow that list down to, hey, here are the 10 where
Right. And then call those guys
I
up and
call
say,
those
hey,
guys up.
look.
Hey, I want to explain this to you. Might be
But
an
that's it,
interesting.
right? So there's like everything we're talking about is super niche, but it's okay. Our job is to help spread the word, right? And just be able to that's you. There's so many little weird elements about QSBS. That's what makes it so
Yeah,
fun. That as long as you're thinking about these
100%.
various little things, if you're aware of it, you can make an informed decision. These founders that we deal, we've talked about this before. The founders that we deal with are whip smart,
Yeah,
all of them, right?
all.
They all dropped out of Stanford or MIT or wherever they dropped out of, and they're brilliant. And each one of those guys or gals, once you explain the rules, they're very fast to understand it.
Very
And they're
fast.
going to chat GPT everything
I know.
or Claude it the whole time, right?
Yeah, the
But it's
number of
okay,
inquiries I get via Claude now.
right?
It's like, hey, Chris, I listened to what you said, but then I checked it on Claude, and you're
Yep,
actually wrong. And I'm
right.
like, hey, you're actually right. Like Claude is right. Yeah, but in all fairness, there's a lot of the knowledge that a lot of the knowledge, even some of the stuff we were talking about today, is out of distribution. If you put Claude, even Blue Jay, which specifically tax trained LLM, like it still requires a good advisor with good judgment
Yeah, yeah.
because there the
Because you don't know what you don't know. You don't know, like are those options there that you should think about, right? Did you convert the LLC? These are, if you don't prompt the right way, you're not going to get the right, or you're not going to know all your options.
Prompting the right way, plus the in distribution versus out of distribution knowledge. It's like they're still not there. There's still a segment of knowledge which never was captured in written form that models were trained on, or it didn't get enough emphasis, and therefore it's just not inside the models. And I see that all the time, and that's the value of the continuing value of a firm like mine, and yours. But I expect that we're going to keep having to compound information really fast on the periphery, because eventually the LLMs will catch up.
Right. And this is just to close this out. Here's what's super cool, right? At some point, if the LLMs are let's say it's an AI company, right, that develops an AI tool that's so good that it's actually delivering legal services. Could you end up at a point where you'd say, no, this is so good, it's not QSBS. This is actually set aside like getting compliance with the state bar. What I'm suggesting is we're always talking about, well, if it's legal tech, it's okay, right? Because it's just building technology to do this. But what if it gets a point where it's actually like an accounting technology that just takes Armanino's job? That's not QSBS eligible. That's accounting.
That's right. Well, I bet I could segment that business in a way that I could get QSBS on part of it. But yeah, look, part of the goal of our business is to drive the cost of accounting services to zero, because ultimately, if imagine that every business on the planet has GAAP audited financials in real time. Okay. Yeah. That unlocks debt and equity finance that we've never seen before. Right now, the plumber down the street, whose spouse is doing the books on the weekend, is basically just a crappy cash ledger. The bare minimum to be able to file a tax return on their LLC. Yeah. Imagine they could attract debt and or imagine they could get through the 33 Act, the 34 Act, the 40 Act.
Right, and real-time cost segregation studies, all of this stuff is going to be,
and be able to go public. They could list on an exchange, because people say it's $1.7 million of compliance costs on an annual basis in order to be listed on an exchange. Imagine that cost goes to zero. It completely changes the dynamic in small business, right? Small business now can attract debt and equity finance. So I don't think about any of this stuff as driving us out of business. I actually think about it as about a $10 trillion unlock globally. Yep. By solving this problem. I mean, the advisory labor is probably another 30 trillion on top of that. But I do think that that is the future, right? Where we can have real-time GAAP audited financials and have businesses that are completely compliant across all of the regulatory frameworks and able to participate in everything that only very large business historically have been able to participate because of the price of admission.
Yep. Yeah. Right. And they'll all be QSBS by that point.
They'll all be QSBS too. The LLMs are going to be so smart about rerouting the infrastructure of the business and planning through a QSBS paradigm. Hey, Christopher, so much fun to chat with you again. I mean, I really enjoy these podcasts with you. You're an amazing guest, and I apologize. I've been calling you Christopher Karachale, and I heard your last name for the first time. It's been years now, and I realize I've been mispronouncing it.
It's okay. My wife mispronounces it too. She has a different pronunciation, so it's okay. We're all on the same page.
All right. Well, thank you very much again. Glad to have gotten this opportunity to speak to you, and I look forward to doing it again in the future.
Indeed. Okay. Thanks so much, Chris.
Thank you. Sure.